All right, so you want to talk about mean reversion trading. Let's really dive deep into this one. So we're talking about finding those stocks that have taken a little dip, but have that potential to spring back up. And joining me to help break this down is, well, an expert on all things market-related. So first off, let's kind of unpack this whole mean reversion thing. It might sound kind of complex, but it's actually a pretty simple idea. Imagine a rubber band, right? You stretch it out. It always wants to snap back to its original shape. Now, think about that in terms of the stock market. Mean reversion trading is basically betting that a stock, after it takes a sudden drop, it's going to eventually climb back up to its historical average price.
Yeah, it's definitely a unique approach. Instead of, chasing trends or momentum, we're kind of looking for those moments where a stock's price gets a little out of whack.
So it's almost like being a contrarian investor, right? Buying when everyone else is panicking.
Exactly. It definitely takes some confidence. Got to be willing to go against the crowd.
Well, we've got this strategy document here from Cesar Alvarez, and it lays out a pretty specific roadmap for this whole mean reversion thing. It's not just picking random stocks that have dipped, right? He focuses on the Russell 1000 index, which makes sense. I mean, these are usually established companies with a history of, solid performance.
And a big factor is liquidity. The document specifically mentions the 21-day average trading value of the stock needs to be over $5 million. So that's a good sign there's enough trading activity to move in and out of positions easily.
Got it. So no super illiquid stocks hiding out in there. Now, one of the big things in this strategy is finding stocks that are trading above their 100-day moving average. What's so important about that?
Think of the 100-day moving average like a trend line, right? If a stock is consistently closing above that line, it generally means it's in an uptrend. Remember, we're not looking for stocks that are just going to keep falling. We want healthy stocks that have just kind of hit a bump in the road.
So looking for that underlying strength, even when there's a dip. And this is where the 2-period RSI, the Relative Strength Index, comes in.
Exactly. And using that shorter 2-period look back makes it super sensitive to recent price changes. So when that 2-period RSI drops below 15, it's basically a big signal saying, hey, this stock might be oversold.
Okay, so not the usual 14-period RSI, but a much quicker indicator. Now, once we've found a stock that fits, how do we actually buy it? The document's pretty specific about using limit orders.
Right, we're not just jumping in at any price. It's a strategic approach. Looking at the previous day's closing price and using the ATR, the average true range.
So the ATR helps us figure out how volatile the stock is, and then we're setting that buy limit just a bit below the previous close.
Yep, keeps things disciplined, helps avoid those emotional decisions, and makes sure we're getting a good entry point.
Makes sense. So we've snagged our discounted stock, feeling good about our diversified portfolio. Now, the million-dollar question, when do we sell? The document says to sell the next day, the 2-period RSI closes above 30.
That's our cue. Means that expected bounce has likely started. Time to lock in some profits.
So we're not waiting for the stock to fully recover, just trying to catch that sweet spot of upward movement. Now, the document mentions a pretty impressive Sharpe ratio of 0.85 for this strategy. What does that tell us, practically speaking?
Well, the Sharpe ratio, it's a way to measure risk-adjusted returns. It tells us how much return we're getting compared to the risk we're taking. And for context, a Sharpe ratio above 1 is generally considered very good. Anything below 0.5, well, that might be a little bit of a red flag.
So 0.85 is pretty solid. It suggests this strategy is giving us decent returns for the amount of volatility involved. It's really interesting how this blends technical analysis with actually understanding the companies in the Russell 1000. It's not just about following signals blindly. Speaking of which, I'm curious about why the exit signal is set at an RSI of 30. Why not aim for a higher RSI, like 50 or even 70? Wouldn't we squeeze out more profit from the rebound?
That's a good point. But remember, mean reversion trading isn't about predicting the exact peak of the recovery. It's about capitalizing on that initial upward momentum towards its average. Waiting for a much higher RSI? Well, there's a risk the stock might reverse before it gets there.
So it's that balance between maximizing gains and managing the risk of things turning south.
Exactly. It's a classic trading dilemma, right?
Yeah.
Knowing when to let profits run and when to take those chips off the table.
For sure. And the document does mention, tweaking the strategy to fit different risk appetites.
Yeah.
So let's say someone's feeling a bit more adventurous. How could they make this mean reversion approach more aggressive?
Well, one way is to play around with the position sizing. Instead of that strict 10% per stock, a more aggressive trader might go for 15%, maybe even 20%, amplifying the potential gains and the potential losses too, of course.
Higher risk, higher reward, the classic trade-off. Now, on the flip side, how could someone make this more conservative?
A few ways. You could tighten up the entry criteria. So instead of buying when the 2-period RSI dips below 15, you could wait for an even lower reading, like 10, maybe even 5. That way, you're only entering positions when a stock is showing really strong signs of being oversold. Another option is to reduce the position size. Instead of 10%, allocate 5% per trade. That further limits your exposure to any one stock.
So it's about customizing the strategy to your own comfort level. Really important point. But ultimately, the big question is, does this actually work in the real world? The document mentions some impressive backtested results, but we know past performance isn't a guarantee of future success, right?
Absolutely. Got to be cautious. No trading strategy is foolproof. Markets are complex. They're always changing.
So how should someone approach this then? What steps can they take to really evaluate this strategy and see if it's right for them?
Well, first, really understand the logic behind it. Then, dive into backtesting, using historical data to see how the strategy would have performed in the past. And finally, if you decide to try it out, start small. Use a portion of your capital that you're comfortable potentially losing.
So do your homework, test the waters, and manage risk wisely.
Solid advice. We've covered a lot here, really broken down the nuts and bolts of this mean reversion strategy. But it feels like we've only scratched the surface of this whole quantitative trading world. What are some other resources our listeners could check out if they want to dive deeper?
Well, Cesar Alvarez's website is a great starting point. He goes into more detail there, even offers consulting services for people who want personalized guidance. Plus, there are tons of books, online courses, even communities dedicated to quantitative trading. Fantastic. And we'll make sure to include links to some of those in the show notes. So much to learn. But before we completely lose ourselves in trading strategies, I want to shift gears a bit. Talk about the human element of all this. We focused a lot on the technical side of mean reversion, but I'm curious about the psychological mindset it takes. It seems like it takes a certain kind of personality to be successful with this.
You're absolutely right. Mean reversion trading, it can be kind of counterintuitive. You need discipline, patience, emotional control. When a stock is plummeting and everyone else is panicking, a mean reversion trader has to resist that urge. Got to see the opportunity in the chaos. It's about trusting the data, sticking to the plan, and not getting swept away by the market's mood swings.
So it's a mental game as much as a financial one.
100%. And just as important, you have to be able to accept that no trading strategy, no matter how good, is a guaranteed winner. Markets are unpredictable. Even the best traders experience losses.
A good reminder for all of us. It's not about finding some magic formula that prints money. It's about having a solid approach, managing risk, and always adapting to the market. So as we wrap up this part of our deep dive, what's the one big takeaway you want our listeners to leave with?
I'd say the most important thing is to approach trading with curiosity and a critical mind. Don't just blindly follow any strategy, even one that looks great on paper. Dig deeper, understand why it works or doesn't, test it thoroughly, and see if it really fits your risk tolerance and goals.
Golden advice for navigating the trading world. But before we completely wrap things up, I got to ask, have you ever personally used this mean reversion strategy? What's your experience been like?
Well, I wouldn't be talking about it if I hadn't tried it myself. I've definitely experimented with mean reversion. It's been, well, an interesting journey, some wins, some losses. But more than that, it's helped me really understand market dynamics and my own psychology as a trader. It's taught me the importance of patience, discipline, and not getting too attached to any one trade.
That's really insightful. It seems like trading, in a way, is a reflection of ourselves, our strengths, our weaknesses. And speaking of reflections, let's recap those key principles of mean reversion, just to make sure everything's clear for our listeners.
Of course. At its core, we're talking about identifying oversold stocks in the Russell 1000, stocks that are still part of an uptrend. We're using those technical indicators, the 2-period RSI and the ATR, to find our entry and exit points. And we're managing risk by diversifying and sticking to a disciplined position sizing approach. Most importantly, we're approaching it all with a clear head. We know that trading is a long game. There will be wins and losses along the way.
Perfect summary. Stay tuned for the final part of our deep dive, We'll explore some more nuances of mean reversion trading and look at how this strategy might evolve in the future. So we're not like waiting for the stock to totally recover. We just want to catch that initial upward swing. The document actually mentions a pretty impressive Sharpe ratio of 0.85 for this strategy. In plain English, what does that actually tell us?
Well, the Sharpe ratio, it's basically a way to measure risk-adjusted returns. So it tells us, like, how much return we're getting for the level of risk we're taking. Just to give you an idea, a Sharpe ratio above 1 is usually considered pretty good. Anything below 0.5, well, you might want to be a little careful.
So 0.85,
Yeah.
not bad. Seems like a decent return for the volatility involved. You know, it's kind of cool how this strategy combines technical analysis with actually, like, understanding the companies in the Russell 1000. It's not just blindly following signals. And speaking of signals, I'm curious about the exit signal being set at an RSI of 30. Why not go for a higher RSI, like 50 or even 70? Wouldn't that squeeze out more profit from that bounce?
Yeah, good question. But keep in mind, mean reversion trading, it's not about predicting the absolute peak of the recovery. It's about grabbing that initial upward move towards its average. If we wait for a much higher RSI, well, we run the risk of the stock turning around before it hits those levels.
Right, so it's all about balancing those gains with the risk of a potential downturn.
Exactly, the age-old trading dilemma. Knowing when to hold them and knowing when to fold them, so to speak.
And the document does mention tweaking the strategy, to fit different risk levels. Let's say someone's feeling a little more daring. How could they amp up this mean reversion approach?
One way is to play with the position sizing. Instead of sticking to that rigid 10% allocation, a bolder trader might go for 15%, maybe even 20%. Of course, that means bigger potential gains, but also bigger potential losses.
Higher risk, higher reward, right? Classic trade-off. On the flip side, how could someone make this more conservative?
Well, there are a couple of things you could do. You could tighten up the entry criteria. Instead of buying when the 2-period RSI dips below 15, maybe you wait for it to hit 10 or even 5. That way, you're only buying when the stock is really showing those extreme oversold signs. Another option, as we mentioned before, is to just reduce the position size. So instead of 10%, allocate 5% per trade. That limits your exposure even more.
So it really comes down to customizing the strategy to your own comfort level. Super important. But I guess the million-dollar question is, does this actually work in the real world? The document mentions some impressive back-tested results, but past performance isn't always a predictor of the future.
Yeah, you're right to be cautious. No strategy is a guaranteed winner. Markets can be unpredictable. They change constantly.
So how should someone approach this then? What can they actually do to evaluate the strategy and see if it's a good fit?
I'd say the first step is to really dig into the logic behind it. Make sure you understand it. Then try some backtesting. Use historical data. See how it would have performed in the past. And if you decide to actually give it a go, start small. Use a portion of your capital that you're okay with potentially losing.
Do your homework, test the waters, manage your risk. Great advice. We've really gone deep here, breaking down the ins and outs of this mean reversion strategy. But I feel like we've only just scratched the surface of this whole world of quantitative trading. Where else could our listeners go to learn more? What other resources are out there?
Well, Cesar Alvarez's website is a great place to start. He goes into a lot more detail there and even offers consulting for people who want some personalized guidance. There are also tons of books out there, online courses, even entire communities dedicated to quantitative trading. Lots to explore.
Amazing. And of course, we'll include links to some of those resources in the show notes. So much to learn. But before we go down that rabbit hole, I want to shift gears for a sec. Let's talk about the human element of all of this. We've been focusing a lot on the technical aspects of mean reversion, but I'm curious about the psychology of it. It seems like you need a certain type of mindset to be successful with this strategy.
Absolutely. Mean reversion trading, it can be kind of counterintuitive. You need discipline, patience, emotional control. When a stock has taken a nosedive and everyone else is freaking out, a mean reversion trader needs to stay calm, see the opportunity in the chaos, trust the data, stick to the plan, and don't get swept up in those market mood swings.
So it's as much a mental game as a financial one.
100%. And just as important, you have to accept that no strategy, no matter how good it looks, is a guaranteed home run. Markets are unpredictable. Every trader takes losses sometimes.
A good dose of reality there. It's not about finding some magical formula to print money. It's about having a sound approach, managing risk, and constantly adapting. So as we wrap up this part of our deep dive, what's the big takeaway you want our listeners to walk away with?
I think the key is to approach trading with curiosity and a critical mind. Don't blindly follow any strategy, even one with flashy results. Dig deeper, understand the why behind it, test it out, and see if it truly aligns with your own risk tolerance and goals. And at the end of the day, remember that the most valuable asset in trading isn't your money, it's your mindset.
Some wise words there. A huge thank you to you for joining us on this deep dive and sharing your insights. And to our listeners, thanks for tuning in and for your never-ending curiosity. Keep exploring, keep learning. Who knows what financial adventures await? Until next time, happy trading. Okay, so we're back for the final part of our deep dive into mean reversion trading. We've talked about the basics, the indicators, risk management. Phew, we've covered a lot. But before we wrap up completely, I've got a couple more questions. First, I'm thinking about how this strategy would work in different market situations. We mostly talked about it in a generally bullish market, looking for dips within an uptrend. But what about when the market takes a turn, goes kind of bearish? Does mean reversion still hold up?
That's a really smart question. It brings up something important. No trading strategy is perfect for every situation, you know what I mean? Mean reversion, like we've been discussing, works best with stocks that are fundamentally strong, part of a bigger upward trend. But in a bearish market, where everything's kind of negative, stocks are trending down, well, it might not be as effective.
So we can't just blindly follow the same rules, no matter what the market's doing. We've got to understand what's driving things and adjust accordingly.
Exactly. A good trader always keeps an eye on the bigger picture. You got to see those market trends and be ready to switch things up when you need to.
Makes sense.
Well,
Okay, so another thing I've been wondering about is how technology is changing trading, especially for a strategy like mean reversion. We've got algorithms now, AI, high-frequency trading. Does that mean human traders are becoming obsolete? Or is there still a place for us, flesh and blood investors in this increasingly automated world?
the age-old question. It's a big one. And honestly, there's a lot of debate about it. No doubt technology's changing the game, and fast. Algorithms can analyze tons of data, find patterns, execute trades super fast, way faster than any human. It's pretty incredible.
So are we all just going to hand over our portfolios to the robots then?
Hold on, not so fast. Algorithms might be great at crunching numbers and making trades, but they don't have that human intuition, that creativity, that ability to adapt. Trading's not just about math. It's about understanding how people think, what they're feeling, anticipating those shifts in sentiment, making judgments based on all sorts of things.
So it's not really humans versus machines. It's more about finding that sweet spot, using the strengths of both.
Exactly. The best traders, the ones who will really thrive in the future, are going to be those who can combine the analytical power of technology with good old-fashioned human judgment and adaptability.
Sounds like the future of trading is going to be pretty interesting. Okay, well, we've covered a lot of ground in this deep dive, from the nitty-gritty details of mean reversion to the big questions about how tech's changing the whole trading landscape. So as we wrap things up, I always like to leave our listeners with something to think about, something to keep in mind as they continue exploring the world of finance. So what's your parting wisdom?
I guess the most important thing is to always be learning and adapting. Markets never stay the same. New information pops up all the time. Strategies that worked in the past might not work today. So stay curious, keep learning, and don't be afraid to question what you think you know. And at the end of the day, the best asset you have in trading isn't money, it's your mindset.
Really great advice. A big thank you to you for joining us on this deep dive. It's been awesome having you here. And to all our listeners, thanks for tuning in, for being so curious. Keep exploring, keep learning. Who knows what financial adventures are out there waiting for you. Until next time, happy trading.